Right. Hello, everybody. We are in the conference room because there are not that many people that are here with us. So that is okay. We are still going to soldier on through tonight's third in our workshop series of the Bureau and Boss Bowl for this year. Tonight's topic is around preparing your financial projections and assumptions. I'm just going to go through my usual portion where I tell you about what the BYOBB is. Again, you all know this, so we're not going to share anything new. Again, these slides will be up in the description below for those of you watching after the fact on YouTube. Um, Best piece of advice that I can always give is to make a startup tree profile. It makes lots of things easier, including saving your submission as you go along. It is a really great resource for you outside of just the BYOBB. Lots of great opportunities there. I did see that our partners at the Small Business Development Center just posted a bunch of events to RSVP too, so be sure to check those out as well. This QR code will take you to the submission portal. It will look a little something like this. Excuse me. The third step that I always like to share is our Google Shared Resources folder. This is where you can find templates, submission examples, eligibility policies. It's where you'll see recordings of these, judge's scoring rubric, all kinds of other important information. So be sure to check that out. And then if you wanted to get in touch with a mentor, you can definitely reach out to them on Startup Tree as well. You can see once you log in on the toolbar up top, there's a little icon that looks like a couple of people that says mentor. You can browse mentors, set up meetings with them. They all, again, are aware that BYOBB is going on, and so they are ready to assist anybody with any questions that they have. Last in our workshop series, it's happening next week, which is crazy to think about. So Fox alum Linda Alunkel will be here pitching, or I'm sorry, giving us the presentation on crafting your pitch. So at the same time, Wednesday evenings from 5 to 6:30 in the 1810 Accelerator. So be sure to come join us and Linda to hear all the great things that she has to say about how do you present your idea, what to include, what not to include, how to prepare for questions, everything that comes to kind of getting everything that you have in your head out into the world, either via your pitch, pitch deck, pitch practicing, all that good stuff. So that's the final workshop. Other key dates, again, March 9th and 10th, right before the submission deadline is when we will do expert mentoring. Submissions are due at 11:59 on March 11th. March 25th is when the finalists will be announced, and then pitch coaching for the finalists will happen April 1st through the 8th, and then the live pitch event and award ceremony is happening on April 15th, so be sure to mark those dates in your calendars. Last thing that I always like to say is we've got about 1 month to actually 1 month exactly from today, which is funny to think about when the submission portal closes. So utilize their Startup Tree mentors, Temple SBDC, the Temple Library that Adam talked to us about last week. Attend. There's only one more workshop, so attend that next week. Do your research, look at industry, customers, competitors, all that good stuff. Validate, and then always get feedback again from people in the field, people outside of the field, all that good stuff. These are the next steps with 1 month to go. So here's a brief agenda for the day. I'm not going to go through every bullet point. I will talk for about 5-10 more minutes, just a little bit about what kind of the BYOBB submission is looking for, what makes a strong BYOBB submission, things to include, things not to include. And then I'm going to turn it over to Professor Carl Kraus, who's going to go a little bit more in depth and answer questions that I can't about how to actually craft a helpful statement, how to think about financials in a much more concrete way. So Carl will be here to walk us through all of that. So here are the requirements for the financials. You need a 3-year income statement that is detailed and that includes assumptions. You need a financial slide in your pitch deck that is a summarized version of your income statement. And you need a financial section in the executive summary. So you are summarizing key points. You are sharing your revenue model, what your expected profit margins or key indicators are going to be. You're going to share financial resources that you have and that you need, what you estimate your cost to launch to be, and then any other major assumptions. So again, all of this is required for the BYOBB submission. Any questions? Okay. I'm just going to keep looking at you. So this very blurry slide, I will clean it up before I post it, but very basically, a P&L stands for profit and loss statement. Basically shows how much money your business earned and lost within a certain period of time. So again, if we're going back, we are looking at a 3-year statement. You can break this P&L statement down in any number of ways. P&Ls are typically used for 2 purposes. One is for results. This is for up and running businesses. I will say, for those of you that have up and running businesses and are entering the BYOBB, you are welcome to include that. In fact, I encourage you to include that. If you have not yet launched, and I think this is the category that most people who are submitting to the BYOBB fall into, these are projections. So your focus for the BYOBB, for the most part, are your projections. You need to answer in your question like this: how much revenue are you bringing in, or are you planning to bring in? Where are your costs coming from? And are we profitable? So again, if we are thinking about, and I'm sure Carl will go into this a lot more, it is very rare for companies in their very first year, maybe even their first 2 years, to actually be profitable. We don't see, that companies start to turn a profit until much further along in their development. And so it is okay to say right out of the gate that you are not going to make $1 million in the first quarter of your existence. Like that is totally fine. What this does do is that it helps identify and plan the needs that we would have for things like cash. It's a great guiding document that talks about what does the future look like. Is there a trend? Is it good? Is it bad? And then what can be changed? It's a great way for you to kind of look at and manipulate what can it change and what impact will that change have on your overall P&L statement. Some components for a startup. So I'm not going to go through these point by point, but just very quickly, revenue, cost of goods sold, gross profit, basically your loss, operating expenses, operating profit, ITDA, which stands for interest, taxes, depreciation, and I always mess this word up. Carl, help me out.
Amortization.
I still can't do it. These are not necessarily relevant at the beginning of the startup. Again, particularly for those submitting to the BYOBB, I would rather you not include them if you are not absolutely sure that they are relevant, as opposed to taking a wild swing and sharing something that is wildly inaccurate. So, last couple of slides just to share very quickly is that the numbers obviously don't tell the whole story. This is why people don't just get to look at financial sheets and make all the decisions in the world. There are a number of factors that go into it. So as you build your forecast, think about the assumptions behind everything that you have put in there and create a spreadsheet of assumptions. You can link to those assumptions in footnotes or comments. This is specifically for your submission, both in the executive summary as well as the slide deck. For you, kind of on your own, this 1, 2, 3, 4th bullet point, please update the assumptions as you learn more. Did something cost more than you thought it would? Did your suppliers' prices actually go down and now things are a little bit less expensive and you can turn more of a profit? So this should be a living, breathing document, which means that you should keep it living and breathing and keep updating it as things change. And as always, again, Adam showed us some great resources last time. Look at how other businesses in your industry are doing similar things. I guarantee you that through some of those resources, through the Temple Library, you should be able to find other P&L statements and kind of use those as good benchmarks to either shoot for or just to get some inspiration from. Question that's always good to think about is, what assumptions are you making? Do you feel confident about those? Do you feel like you are just doing some wishful thinking, or do you feel like you're being truly accurate? An assumptions example is, so let's pretend that this is a company where their revenue that they're making is based on a number of subscriptions. So the number of subscriptions that you are then breaking it down is what is the number of people you can reach? That's an assumption that you make. Is this based on demographic, geography, or a channel like a YouTube channel, something like that? What are the conversion percentages? So of those people you can reach, how many of them are actually becoming active subscribers? And then once they have a subscription, how many months are they lasting per subscription? You may start out by saying it's a 3 month free trial and then we'll charge you after that. How many people do you think are going to cancel after those first 3 months? Or, do you just sell 6 months at a time and you hope that they stick around after that? All those things are important to think about as you're making assumptions. I think that is the end of my slides. I guess I should pause there. Any questions about kind of like what should be included for the BYOBB?
Uh, I just want to know with assumptions, like how would you, are there any frameworks that we can use to assume?
There's a great document. If you can't find it, let me know and I will send it to you. But there is a great document on the shared resource folder. I think that lists a bunch of different assumptions that you can think about. So check that out. I don't, again, I think like with all the, there's not like a number of assumptions that you need to hit, right? If you make 4.5 assumptions and you're over that, you're great. Like that's not really the way. If you can make some assumptions that you feel like are good assumptions and tell a good story, then you're okay. But you don't need to list 17 assumptions in order to make a strong submission. Does that make sense? All right. So with that, I'm going to turn it over to Carl and let him take it from here.
Thank you.
Thank you. I will be right back.
So, just by way of quick introduction, I come from a technical background. I have a undergraduate degree in chemistry and worked in industry in corporations for about 22 years or so, doing product development in a bunch of different fields, launching new products and commercializing, forming new commercial operations within corporations. I left there, became a consultant, working primarily with early stage companies and also the investors that invest in early stage companies. And have been doing that for about 25 years now. And I've been teaching at Temple here in the IEI programs, primarily in the MBA programs, since 2019. So as a chemist, even I can do financial projections. So trust me, anybody can actually do this. So basically, when you're budgeting or when you're doing these projections for a new business, you're looking at three fundamental important issues. The first is that you need to know how much money you need to start the business. How much do you need to launch to the point where you can start selling your product or your service to your customers? So that's the startup expenses. And then, of course, the question is, where are you going to get the money from? What's the sources of funding? The second one is the funding, the financial operating projections. This is the 3-year projections that Neil was talking about that's part of your submission for the BYOBB. This is going to essentially be your best guesses, your assumptions that drive this. And we'll go through how to do this and the types of assumptions that you're making along the way. And then the third one, which they don't really look at as part of the standard package of BYOBB submissions, I don't think, is cash flow management, but I'm just going to touch on that at the end, towards the end, just to give you an idea of why that's important and what it is. So, why do we need to do this? Why are you doing this? Why does the BYOBB require this as part of your thing, your submission? The first and foremost is you need to make sure that you have enough funds available to get the business started. One of the reasons that businesses fail early on is that they run out of cash, basically. They're developing a new product, they get halfway through and they find out that they've run into problems, spent more money than they expected, they have no more cash and they can't move forward. So essentially the business fails there. The other is once you do have your product or your service developed and you're out marketing, you may find that you're, as Neil was saying, for that first year or for the first 6 months, you may not be making a profit. So you're chewing through cash, and we'll talk about how you can plan for that as well. The second is, and it's related to that, you've got to verify that this business model that you have is actually feasible. Can you charge enough for your product and sell enough of your product or your services in order to cover all the costs of the operation of the business? The third one is, well, we talked about the running out of cash in the early days, and then it sets goals for raising the financial funding that you need before you start fundraising. So you know how much money you need. When you're looking at fundraising for a new business, you want to understand the amount you need, what you're going to spend the money on, and then what type of business it is as well. Those three things primarily will determine where you're going to look for money, what type of money you need, and where you can go try to raise it. So in order to do this, what do we need? We need estimates of all expenses required prior to the launch. And the other one is we're going to need estimates of that first 3 to 6 months operating expenses as well. How much is it going to cost to operate the business? And when we talk about estimates, we're talking about assumptions. This is where we start getting into what assumptions are you making and how can those assumptions change as you go along learning more and more about the industry, about the market, about your product or service. All those things drive your assumptions. So these are some examples of different types of revenue. Revenue and sales are the same things. So when we talk revenue, we're talking about sales, the dollars coming into the business through selling your product or service. So you can get product revenue, you can get sales, service revenue, you can get sales revenue, which is really related to the other two. And then you have direct expenses. Direct expenses, in this one slide that Neil had shown, was referred to as cost of goods sold. This is how much does it cost to make and deliver the service you're providing, or to make and deliver or ship the product that you're developing. So these are things like the raw material costs that go into the product, the production expenses, the actual manufacturing expenses, or in the case of a service, it might be, if it's a cleaning service, it might be the cost of the cleaning supplies that you need for the service, and also the cost of the labor that goes into the people that are doing the cleaning, the actual the delivery of that service. Sales expenses, these are things like your advertising, sales and marketing, really, advertising, promotions, your social media, paying for influencers, things like that. It can also involve things like travel expenses if you actually have to go to customers to do an in-person sale. It might also include things like having a booth at a trade fair or at a farmer's market, paying for a booth at a farmer's market, things like that. Those are all sales and marketing expenses. The administration expenses, this is the administrative stuff, the bookkeeping, all those kind of things that don't directly relate to your operations, but they support the operations. Sometimes they call these the back office kind of things, kind of expenses. And then your personnel expenses are obviously what it costs to have your employees. So this would be salaries, benefits, training, things like that would be under personnel expenses. The capacity expenses, that's really just more administrative expenses. Normally they're wrapped into the administrative expenses. It's the cost of your office, your printers, your computers, all that kind of thing. And then, as Neil said, we aren't really interested in interest and depreciation and amortization and all that kind of stuff. because as a startup business, you don't know what any of that is going to be. It's really hard to project those unless you know you're going to go, for instance, you're going to get loans to support the startup, and then you can calculate what the interest expense would be on those loans, things like that. But for our interest, we're really looking at what's called operating profit, or EBITDA, which is the earnings before the interest, the depreciation, amortization, taxes. I didn't do that in the right order, but that's okay. And then finally, when you take all of that revenue that you made at the top here and you subtract all these expenses that are underneath of it, what's left over is your profit. And if that profit is negative, it's a loss. It means you spent more than you actually brought in through sales. So we're going to go through and look at this as an example. What we're going to use is it's not a fictional firm. It's actually a firm I worked with at one point. But it's going to provide roadside service for transportation firms. And by transportation firms, we're talking about large trucks. So this is a roadside service for trucking firms. The operational requirements they have is they're going to need mechanics. They're going to need the vans that the mechanics can drive out to the roadside to service these trucks. They're going to need parts inventories, because when you drive out to the side of an interstate to service a truck, you want to make sure you have most of the parts you need in that van, because you don't want to drive back. And then they also need the management and administration. They need somebody to take the phone calls that are coming in, saying, gee, I broke down, looks like my brakes are shot, that kind of thing, so that they can then dispatch the service mechanics to go out and take care of the disabled vehicle. They're also going to need facilities. They're going to need the office space and the office services, all that kind of thing. They're going to need parking space for the vans, because the vans are, when they aren't out on the street, out on the highways, are going to need some place to park and to get loaded up and things like that. And then they need warehouse storage for the parts. Other requirements they need, they're going to need marketing, they're going to need website, things like that. They're going to have to do direct sales efforts with transportation. When we talk about direct sales, this is where you go face to face and you're selling the service to a trucking company. You actually have to show up and do this in person. You can do some of it by email, and a lot of the communications by email, but you still have to do that. And then another big ticket item is the insurance. You've got mechanics working on the side of an interstate with traffic going by at 75, 80 miles an hour. Your insurance is going to be pretty heavy to protect your equipment, to protect your employees, all that type of thing. So insurance is another big ticket item. So this is an interesting firm. It was something at the time that we worked on it about 12, 15 years ago. It was something that was pretty much unheard of. They have roadside assistance for cars. With State Farm does it on Turnpike in Pennsylvania, or sponsors it at least. But for these large trucks, they really didn't have this kind of a service. And again, this is for simple things. If they blow an engine, it's got to get you have to get one of those big tow trucks and get it. Pull it in and work on it. But if it's something like the brakes, or they've got a leak in their air brakes or something like that, that can be fixed on site. So this is all of these sheets are taken out of a consolidated workbook that I have that does all the calculations for you. But you need to make all of the assumptions. These are all assumptions. Now, you can make better assumptions by doing research, by talking to other people that have similar businesses, by doing the kind of research that Adam talked about in the workshop last week, those types of things. And that's what all these numbers are based on.
Some of them you can actually just get direct. Like I'm looking at the accounting software QuickBooks. Like you can just get a quote for QuickBooks and know that you're going to spend 160.
Yeah.
Yeah.
And these are older numbers. I think this is from 2021. QuickBooks is probably more expensive than that at this point, but I think I forget what it is at this point. But anyway, so the things that you're worried about for startup expenses is number one, they're going to have an office. It's not much of an office, but it's an office. And so they found one, they already had the lease agreement on paper at least. And it was going to be a month basically of a month of rental, which was $700. They didn't have to pay the security for it. It was just the first month's rent. Website development, they knew was going to be about $2,500 to get somebody to do the website, because that website was probably going to have transactions on it as well as just being an informational website. Liability insurance, that is the first month of liability insurance. $2,500 a month. Again, very risky. So it's important to have very good insurance to protect the company. And so on. You go through office equipment, legal service fees. They're going to have contract language drawn up, things like that. So before they could even make their first sale, they had to have that standard contract in place. Tools for the vehicles. They're going to lease the vehicles, so it was only the lease initiation, which was kind of that down payment that you pay for vehicle leases. And then they had starting inventory for two vehicles, for 2 trucks. And then the other expensive item is the workers' compensation insurance. This is insurance to cover your employees if they get injured. It provides coverage for both the medical expenses related to that injury, but also for salary continuation. And you add that all up, and that comes to about $20,000 roughly. You can see down here in total startup expenses. And we'll find out where this number comes from in a few slides, but we also look at what is the first 6 months worth of operating expenses, and they estimated that to be about $80,000. So it's about $100,000 total they need. Notice I'm talking about, and it's important. This is all estimates, assumptions. As I tell people when I'm working with them doing this kind of thing, you are building a piece of fiction here. It's all made up numbers, but you want to make sure you base them on the best information you can get today. And as Neil said, as you go along, these are probably going to change because you're going to learn something. As you go along, you're going to keep learning information. What's nice about doing it in an interactive spreadsheet like this, or workbook, an Excel workbook, is you can update your assumptions and it'll flow to the calculations. So for instance, if you find out website development is actually going to be $5,000, the next for $2,500, that $20,000 down here will increase by $2,500. You'll be up to $23,000 if I did my math right. Okay. So again, we're looking at round numbers, and when we get to what you're actually going to present, we're going to look at rounding off these numbers and making them much simpler. So over here, there's just a little thing that says, okay, well, we need $100,000. Where are we going to get that from? So that forces you to think about that right from the top. And so the owners they were going to make investors, 2 founders, they're each going to pop $20,000 into this. And then one of the owners had much more money, and they said, okay, in addition to investing directly into it, I'll also make a loan. And then that was going to be paid back to that owner over time. Any questions? No. We'll be coming back to this page probably. Okay. Now we get into assumptions. More assumptions. So this is
More assumptions?
More assumptions. Oh, there's much more assumptions. These are assumptions related to the operations. So at the top here, we are looking at what are they providing. This is where you need to distill down what you're doing to a few simple products or services. It's very general, but again, these are all estimates. You don't have to list everything. I've worked with restaurants where they've come to me with spreadsheets of, okay, hamburger is going to cost us this much to make, and we're going to charge this much. A cheeseburger is going to cost us this much to make. We distill that down to, you're selling a lunch, you're selling a dinner. And maybe you're selling a simple lunch and a more expensive lunch, and a simple dinner and a more expensive dinner. So you might have 4 products that you're looking at. And about what are you going to sell that for? And about how much is it going to cost you to make that thing? So in this case, they said, okay, simple repairs, more major repairs. These aren't the major repairs like replacing them. These are major repairs like replacing brakes. So their plan was that the minor repairs were going to be about $350. Major repairs were going to be $750. And then the direct cost for the parts and the fuel and everything else to get the truck out there and back, and their van to get it out there and back, and the parts that they would use for a minor repair are about $100 total, and then $350 for the larger repair. These are their assumptions at that moment. As it turned out, all these numbers got much larger when they actually launched the business. And then they were also going to, regardless of whether it was a big repair or a little repair, they were going to charge $100 just to send somebody out there in the first place. So it was just a flat fee. So that's just a flat fee. So there's no cost associated with that. Okay. So looking at this is your price, your selling price. This is the cost of goods sold. In this case, the cost of service and goods that are sold, goods, parts, and service. Okay. Again, just to be clear, this is what you're going to collect from the customer. This is what it's going to cost you to do that service. So you're going to pay this, the customer is paying this. Whenever you're pricing things out, this should always be bigger than this. Good rule of thumb right there. Okay, so then we look at the monthly expenses. These are also sometimes referred to as fixed expenses, but these are your operating expenses, another term that's used for them. So you have the building lease, you have the rent payments for the offices and warehouse space, the utilities, heat, electric, that kind of thing. Your insurance on a monthly basis, telephone costs. They were going to have an installed telephone system, so it was not inexpensive. Server, it's $30 a month for their website and email. Office supplies, the workers' compensation insurance, software leases, the vehicle leases, accounting services, and then virtual payment drafts. This was a bank fee that they were going to be paying for payments to be coming in through, because large transportation firms, large trucking firms didn't want to be writing checks or that kind of thing. They wanted to just be able to make a payment through the electronically, and so there's fees associated with that. And then maintenance on the vehicles. If you have any vehicles, you always want to budget, in this case, project that you're going to have to spend money to maintain those vehicles. Oops, sorry. Okay, then we also put in here assumptions. What's the inflation rate going to be? Because you're looking at 3 years. So back in 2021, inflation of 2% was very conservative. That was a really high number back in 2021. Now you might put 3 or 4% in there, not knowing which way inflation is going to go for the next 3 years. And then if you're going to be offering benefits for your employees, you have to put in inflation rate for benefits, but benefits inflate much faster than everything else. So in this case, we assumed about 10% each year that benefits would go up and cost 10% each year. The other things down here, I'm not going to spend a lot of time on. I mean, the benefits are saying about 100 per employee per month. This is just a payroll processing fee that for every check, if you use payroll service, every check that gets paid to an employee or every direct deposit, there's a fee associated with that. We won't spend a lot of time on that. Any questions about this?
What do you mean by the inflation rate for benefits will go 10% higher? Like, I didn't get it.
Because if you look at the cost of health insurance,
Okay.
it goes up by about, it had been going up by about 15% a year.
Oh, okay.
So that's one of the benefits they would offer. Yeah, and they also offer like life insurance, which doesn't really change very much. But so the average inflation per year is 10%, probably a little more than that right now, maybe 12%.
Okay.
But that's, and again, it's just to cover the benefits. And like I said, we're talking, day zero, it'll be 100 per month per employee, and then each month it'll go up a little. Well, we actually do calculations on a yearly basis. Each year it'll go up by 10%.
Okay.
Okay. Meanwhile, this inflation rate means that all these costs will go up by 2%. Okay, so this is where it gets important to clearly define what your units are that you're selling. What is it you're selling? Small lunch, big lunch, small dinner, that kind of thing. Minor repair, major repair. So in this case, what they're doing is they're saying, okay, now we're going to look at how many services of each type per month do we think we're going to sell. These are all assumptions. They're educated guesses. They knew right out of the gate, as soon as they started, that they would have service because they already had somebody that had committed. One of the smaller trucking companies in the area had committed to using the service. And they had information from them about how many breakdowns they have per month and things like that. So they knew that this one was pretty locked in. As far as good guesses, well established, supported assumptions. So again, they're doing a total of 13 service calls, so they're going to get 13 service call fees. So it's always the sum of these gives you that number. But so they're going to, in the first month, for instance, they're going to have 10 minors, 3 majors. You get out, you'll see it's growing, and this is because they're going to be out there doing sales. They're going to get more trucking companies involved in this. And so you see a kind of a slow progression of, they're going total services up to 46. May, June, July kind of levels off a little bit because the trucking salespeople or trucking service people are going on vacation and all, so they aren't worried about buying services, so they aren't going to increase during that time. And then it starts, and then all of a sudden starts jumping up quickly because now they've gotten a name in the industry. It's easier to make sales. They're getting more and more trucking companies involved. Okay. That's the logic here. But again, these are all assumptions. We're assuming that it's going to die a little bit in May, June, July, and then it's going to take off because we've got a name. We're assuming that.
Can we get back to that? Because I feel like a question that I often get is we assume it's going to take off, and we can make a decent assumption about when it's going to take off, like you said, build a customer base, more trucks are back on the road, all that sort of stuff. How do you get to, these are obviously round numbers, which means they're just guesstimates, right? There wasn't like a formula that was put in. So how do you, I think a question a lot of people have is how do you decide how much it's going to go up by? Like how do you jump from, why the jump from 40 to 50 and then 50 to 75 and then that big jump from 75 to 125?
Right. So you need to, in order to do this, you should have a story that explains every number, basically. So again, this is where you need to have enough knowledge of the market, enough knowledge of what you can do, which is the other important thing, your capacity for what you can do. And then, viewing how do other service businesses grow? Getting to understand that, once you have 3 or 4 customers, and if you look at about 13 per customer kind of thing. So you've doubled the number of customers, that kind of thing, in these time periods. That once you get 5, 6, 7 customers in a region, in a fairly integrated industry like trucking, everybody knows what everybody else is doing. Then you got traction, and then you can start taking off. Oftentimes you'll see with new technologies that they have what they call hockey stick growth. It's a myth. And investors know it's a myth, but everybody puts this very slow growth, and then all of a sudden it takes off. It's more like this, where it's growth, and then you get a little steeper, and then you get a little steeper, and then you get a little steeper, and so on, which is typically what happens. So again, you need to have a story that is backed up by facts and research. In order to have something that is defensible. So when you're doing any of these assumptions, whatever assumptions you're doing, you're assuming that somebody's going to want this service. Well, you should have some information. Like I said, they already had one customer lined up. So yes, they want the service. That's good. You've kind of proven that point. And so on. But you want to, I refer to them as hypotheses a lot because that's what we do in science. But you need to be able to have information that at least is credible story that supports the hypotheses or the assumptions that you're making.
Thank you.
So then we worry about personnel. We're going to hire people in here. So you're going to have different people you're going to need. And then what their annual salaries are and when they're going to start. So for instance, we're launching this in January. Remember, we started out in January as a start date. So we're going to have a dispatch manager in January, and we're going to have 1 mechanic in January. And then as it grows, as we get more business, we'll add a 2nd mechanic in August. And as the dispatch manager gets overwhelmed with calls, hopefully, they're probably going to be out doing sales some too. They're going to get an office manager in. But note, the president and the vice president aren't getting paid until the 2nd year. These are the owners. And they are just saying, to make this thing work, we can't be taking a total of $150,000 out of this business from day one. So they personally have to have enough money in the bank or some other income coming in to be able to live. So that's a personal planning that you need to do as well as you're doing this plan, when you're doing this financial planning here. Okay. So again, we'll get back to where these people are coming on board to the business. We'll see the effect of that. And we see it right here. So this sheet is then all calculated based on all the assumptions we just made. Okay. And we'll go through that relatively quickly. For instance, in January, we have product sales of $5,700. If we go back to here, and remember that our sales are $350, $750 for the products. The service is a separate line. So the products are either $350 or $750. And then we go here and we say for the first month, we're going to do 10 of those. Well, 10 times 350 is 3,500. 3 times 750 is 2,250, I think.
Very good.
So 3,500, 2,250 would give you 5,750. How they do?
Checking.
Oh, look at that.
Pretty good.
5,750. So that is how all of these numbers up here are calculated. Up here. You're just the number of units times what you're charging per unit. Likewise, the cost of goods sold line is the number of units you sold that month times what it costs to deliver that on that assumption sheet, the first sheet. So, second sheet. Okay. And then you add these two together, subtract this, and it comes to $5,000. Almost like I planned it. Okay. Then we get to the salaries. Now, this is a monthly salary. Up here, we were annual salaries. But when we start out, we've got a 50,000 salary and we've got a 40,000 salary. And that's all we have in January of 2021. So you've got $90,000, divide that by 12. And trust me, it equals 750, 7,500. Payroll taxes, something if you have employees you have to worry about. This is 7.65% of the salaries. So where did I come up with 7.65%? Any ideas what a payroll tax is for a company? Okay. So when you get your paycheck, there is deductions for federal taxes, state taxes, city taxes, all that kind of thing. They come out of your pay before you get your final number, your net pay. Also included in there is Social Security and Medicare taxes. Social Security plus Medicare together is 7.65%. You pay that. The company also pays 7.65%. So the total is 15.4% is taken out of 15.3% is taken out of or taxed for Medicare and Social Security total. Company pays half. Yeah. So when you're budgeting, you need to make sure that you're budgeting for what comes out of the company's coffers. Pay for that. Okay. Remember, we had a payroll processing fee, which is what you pay the payroll company to take care of all this tax stuff and that kind of stuff. So you don't have to worry about it. And then the benefits. And that's based on number of employees, which that should be 200, not 600. So there's an error there. And then we have all those numbers. Notice all of these labels, all of these numbers are here. Right, same numbers, they just carry over. Oops. Now I've totally went over. Okay, so we're back here. So we take, in this case, I took personnel costs here, and then the other operating costs are down here. You add those two together, they're your total operating costs, including personnel, which comes to 13,200 roughly. Up, but we only brought in 5,000 in sales. We spent 13,000. So we have a loss. This is EBITDA or operating income. We have a loss of 8,200. So when you're doing accounting, if you have a loss, you put it in parentheses. And if you're fancy and have colors, you make it red too. But you put it in parentheses, that means negative. So we don't have a bunch of symbols on our parentheses here. Okay. So, and so on. You see the growth in sales that we had in the number of units. More units were being sold. And eventually it really starts growing quickly, which is great. It's fantastic. You also notice that as the sales grow, though, your cost of goods sold is growing too, because for every sale you make, you've got that cost to supply it, to produce and supply it, that's added in there or subtracted from your sales. Also notice down here then that for the first 3 months, you're losing money. You're burning cash here. Remember on the first slide where we were looking at what's it going to cost to start and how much cash do we need on hand, we put in 6 months of operating expenses. That's basically the addition of these 6 months. So it's 6 times 4, 24,000, 25,000, something like that, right? No, yeah. 25, 26,000, probably something like that, right? Seems like it would, oh, I'm sorry, it's not that number. It's the sum of these two numbers summed across here, your total operating costs. We don't have a line where it does that. So it's 12,000, 13,000 roughly a month. So if we go back up there, that's where this 80,000 comes from. So the reason you put that in there is so that you have sufficient cash to get through these lean times where you're losing money. And again, these are all assumptions. So what happens if you're overestimating? You might not be breaking even until down here someplace. So you want to make sure that you have enough cash on hand so you don't starve the company and run out of cash and not be able to pay your bills. Okay. I just used the term break even. Let's break even. So right here is where we hit break even. We're losing money, we're losing money. Oh, now we start making money. You haven't broken even for the year, but in your monthly operations, you are now profitable rather than losing money. Okay, so this is your break even point. You have to get to the point where your cumulative income starts growing because we have cumulative losses here that we have to make up for here. And so somewhere around here, August or so, with some of these, actually it's probably here where it goes, makes the break here. But from August back, that's covering these initial losses. So now you're at true break even where you're now profitable. And you can see at the end of the year that they made 141. They would make 141,000, assuming, given, I shouldn't use assuming, given that the assumptions are all reasonably accurate. Okay?
Yeah.
And again, all this gets calculated based on all of these assumptions. So when you ask how many assumptions do you have to make? A lot. You're going to make a lot of them. You don't need to detail all of these assumptions in your submission.
Yeah.
But if you present this as an attachment, they have all the assumptions.
Yeah.
And then somebody can go look and say, because normally when I'm reviewing a funding proposal or a request for funding investment, you get this. Usually you get something along the lines of this level of detail. So we asked the question that you asked, which was, or that Neil asked actually, that why is this all of a sudden take a jump? What's going on there? I mean, okay, you got nice organic growth here, all of a sudden, boom, it's taken off. Why? And you need to be prepared to answer that question. Okay. Any questions about any of that? A lot of numbers, but again, you build off of your assumptions, and if you have your assumptions set up in a structured way like this, you understand, you remember what they were, where they came from. Always good to have a notes along with it saying, okay, this is assumed because I talked to so-and-so or that kind of thing. So you have your references for where your information's coming from.
I'm just curious to know, like, how would it look like for a company which is a subscription model, plus it's more like seasonal, as in, let's say it's an edtech company. So before the start of the semester is when most of the people would subscribe. So how would it differ?
Right, so that would be reflected back here in your units. So if you were educational, you're talking about, right? So, and it's a subscription. So once they buy it, they'll continue using it?
Yeah,
Okay, so this gets into the example that Neil had presented earlier in the, as far as assumptions go. So there's a couple of assumptions you need to make. One is, when are most people going to be signing up for a subscription? That's the first one. You're assuming that it'll be August, September, at the start of the semester for the academic year. And then you may get another blip in January, as people are getting tougher courses, whatever you're doing, but tougher courses, or you've got transfers from other schools, whatever's coming on. During June, July, you probably have very few new customers, right? The other question is, how long are they going to stay subscribed? Will they cancel their subscriptions in May and then renew their subscriptions in August? So that's another question, another assumption you have. And then the third assumption is, and it's a series of assumptions, again, how many are actually going to sign up during the hot spots of, what did we say, September or August and September, and then January? How many are you going to get? So there's basically three fundamental assumptions there. One is the seasonality. When are you going to get the sales, which you'll put in the numbers here, the new ones, and then how long will they stay around? Okay. The third thing is, and this is where it gets tricky, is that say you have somebody sign up, say you have 10 subscriptions, let's just use these numbers, 10 subscriptions in January, and they're going to carry through till June or till May. Meanwhile, in February, you're going to get another 2 or 3, right? Rather than 15, because it's going to drop off. If this is your fees, your monthly fees, well, you got 10 in January, you're going to have 10 monthly fees in January. You get another 2 there, it's going to be 12 now. You get another 2 here, it's going to be 14. You get another 2 here, you get 16. All of a sudden, you get none here because it's the end of the semester, and all these guys cancel, so this is 0. Okay, so you have to figure that out and then build that into your units. Likewise, if you go along here and you say, okay, I've got 150 in December, and we add 10 more, and so you've got 160. That 160 gets, if you loop around to the next year, this number down here would be 170. If you'd have 160 from December, you'd assume they'd keep using it because they're so satisfied with your superior subscription service, right? And so they'll continue, and then you'll be adding on another 10 to join in January.
yeah, that was actually my second question. About how would you handle the existing subscriptions and the new subscriptions in a table like this?
That's basically, like I said, this one would probably be your subscription fee. And that's what it would be. This would be new subscriptions.
Yeah.
And this might be
The levels of the subscriptions, as in
A
is.
Yeah, no, this would, well, if you've got different levels, then you're going to have new low-cost subscriptions, new high-cost subscriptions, and so on. So you're going to have to break it out more. It takes some finagling with the tables to do this. So if this was, let's just keep simple, it's just one level of service. So we have new subscription or existing subscriptions, new subscriptions, and just leave it at that. Okay. But then the existing subscriptions would be 10 this time. New subscriptions is 3. The next month it would now be 13, and then you'd add new ones. And then the pricing on these would be the same unless you have some kind of a setup fee for every new subscription. Yeah, so for this, probably not, but if you're doing something like you have to install stuff into a company's computer so they can use your SaaS system, for instance, then you'd have a setup fee. That would be a different fee for a new subscription. So again, you have to think through this a little bit about what's the model, and then also, like, I'm just making things up here about the seasonality and all, but you should be able to gauge what that actual seasonality would be. And you'll see the same thing. In this case, they're building the business up because they're retaining their old customers and adding new customers.
Okay.
If you look at a retail service, a store, online or brick and mortar, basically what you see is that January sales are low, February sales are low. They start picking up in March and April, May, and then they kind of tail off a little bit in June, July while people are out vacationing and sitting poolside and not buying things. And then it grows up, and all of a sudden in November and December, it shoots up for the holidays and then drops in January again. So that's a different kind of seasonality, but it's the same kind of thing.
Also, one more thing. What I have seen, like when I was working for a construction subscription-based company, a construction market intelligence subscription-based company, is that companies would sign, like, would agree to it and like would sign on something for the subscription, but the money would come after 2 or 3 months. So like, how would you handle that? Which like would you put the number as, let's say the company signed in like is supposed to sign in January, like would you put January or?
No, typically what I do here is you put the units in when you get paid for the units, not when they are ordered.
Oh.
That way it tracks with the cash coming in, which is what we want to,
Okay.
you want to book the sale. So yes, there are systems where I'm get too far in the weeds here, but if you have an accrual accounting system, you will book the sale when they sign.
Okay.
But if you have a cash accounting system, you book the sale when they do. For a startup business, just to figure out what makes sense and whether it's feasible, I assume you're on a cash basis, just to keep things simple.
Yeah.
Any other questions? No?
Yeah.
Okay, and then just an example here of cash flow and the importance of thinking about the flow of cash into the business and the flow of the cash out of the business. This is an example of a company that was going to install systems in 55 plus communities so that grandparents could easily video chat with their grandkids, that kind of thing. And so it consisted of a simple Chrome computer, that had a camera built in, that kind of thing, and speakers and all that stuff. A modem, router, modem, and then the software for email, and so they could also email the kids because old people like to write. But email and also the video software. So in this case, I have to remember what the base numbers were. I think the equipment was, 7,200 divided by 18. I don't know what that is. I can't do that in my head.
Well, that's 7,200 divided by 18.
Yeah. It's 150 or something.
400.
400? Okay, so it's $400 for the total equipment package. And then they were going to have independent contractors actually go out, do the installations, and do a quick teaching of how to use everything. So they went to a 55 plus community. They sold the community on a pilot trial of 18 units that they were going to install this for. And if that all worked out, then they come back for more. So in this case, they go out. So they start out with cash in their bank account of $9,000. They go out and buy their 18 units, but they use credit card. They go to Best Buy and buy the stuff, put it on a credit card. They get the equipment, and then the installers start doing, it's one installer, he can only do 6 a month, 6 a week. So he starts installing, they start installing the week of the 9th of May. Gets the first 6 done, submits an invoice to the company for that first 6 for $600. Gets the second 6 done, submits an invoice to the company. Meanwhile, the invoice then gets paid, the first invoice gets paid here. Does the 3rd week of work, submits the invoice, everything's good. Okay. Meanwhile, 25 days later, 20 days later, the company receives the credit card bill for the units that they bought. See how this is all timed, right? So the full 18 pieces of equipment are installed here. Now the company submits the invoice for the entire project to the 55 plus community because they've delivered everything. At the same time, they pay the second invoice for the installer for the second $600. So now they're down to $7,800 in their bank account. And then finally, they pay the 3rd and final installment to the installer for $600. They're down to 72. Still 72. But now, 30 days after they receive their bill, their credit card bill, they have to pay it. So now they pay the $7,200. This is what's great about credit cards. If you stretch out about 6 to 7 weeks typically,
yeah,
depending on your timing. At least 4 weeks and sometimes 6. But that eats up their entire bank account. And because these guys at the 55 plus community pay every 30 days, it takes 30 days to get this invoice paid. So they have to wait another week before they get their invoice paid. But now they've got the extra $4,500 profit that they made, right? Great. Everything worked out nicely. Isn't that comfortable? Except what happens if, as soon as this is done, the people are raving, and here the 55 plus community says, we want 36 of these now. How are they going to pay the installer? They don't have any money. And they can charge the units again. You know, they can charge 36 units and they won't have to pay it till out here in July sometime. But they've got to be able to pay this guy to do the installation. And they don't have any money to pay. That's cash flow problems. That's why we want to look at these kind of timings to see how to make sure that we have enough cash in the business all the time. And again, you don't need to do this, I don't believe, you don't need to do this for the Be Your Own Boss Bowl, but it's something to keep in mind as you're looking at growing the business. This is the classic problem of you grow too fast.
Yeah.
And you outrun
You
your
can't
cash.
keep up.
So again, this is where, when you're actually looking at how much money you need to launch the business, if you really think you're going to take off very quickly, you need to make sure you're asking for enough money to be able to finance that type of thing. Just wanted to throw that in there for
it's a great exercise for people to work through. So,
and the workbook that I used for all of the financial projections is available. If you would like a copy, you can email me
for a small fee.
I don't think I can charge for that.
I don't think you can.
But anyway, that's available. Just email me, and I will send that to you. I will also give you some explanation around it that will help you to understand how to use it. Because there are some, not tricks, but there's just some policies you need to follow in using it. And then also, as we just talked here, if you have a special case and you're confused about how to apply this, email me and we can take 15 minutes. I can guide you through and help you figure out like that the subscription question. Be able to help you show you how to best use this. And again, it's not perfect. It doesn't have to be. There are assumptions. They're all assumptions. It's all fiction. Just keep that in mind. Two things. Number one, you don't have to get really upset about dollars and cents. You're really worried about the big piece of the number. And number two, don't be afraid to change things when you find out things, because it is fiction. Don't get married to your numbers. Be flexible with them. That's my words of wisdom for the day.
That's the great words of wisdom. We appreciate it. Just slide that mouse back over. Thank you. All right, so I will leave this up for just another moment or two. I should also probably include a link in the video description, but this is just the workshop. Like I said, next week, our last in the workshop series. And I think that is it for the evening. So thank you all. Again, reach out to myself, the IEI inbox. You can reach out to Carl if you've got specific questions or want a copy of the worksheet that he drew up. But appreciate everybody watching and good luck with your submission.